Do you want to invest in real estate, but you don't have a whole lot of time to do it? Well, in this video, I will show you 4 passive ways to invest in real estate even if you don't have that much time, where you hardly have to lift a finger to get started. Okay, that might be a bit of an exaggeration. Hi, my name is Ryan Chaw, your friendly neighborhood real estate investor, and I show new investors how to buy their first profitable investment property. When I first started buying real estate, I wanted to start off with an investment that required very little time because I was a busy pharmacist taking care of a lot of customers. Trust me when I say, I wish I knew about all of the different ways that I will be going over in this video to passively invest in real estate. Quick pop quiz. True or false? It is possible to invest in real estate with less than $100 in your pocket. The answer is true. This brings me to the very first way that you can passively invest in real estate, and that is by buying into an REIT. This is the closest you can get to a set it and forget it type of investment. Now, the acronym REIT is just a fancy term for a large group of people who pool all of their money together to buy a large commercial property. And if you have less capital to invest, REITs can be a great way to dip your toes into real estate. They can feel complicated, but they're actually not. And understanding how they came to be will help you know the power of investing in REITs. The forefather of REITs was Sam Zell. Mr. Zell immigrated to the United States and went to college at the University of Michigan, where he managed a 15-unit apartment building in exchange for free room and board. By the time he graduated at the age of 24, he was managing several properties and netted $150,000, which is equivalent to $1.1 million today. Not bad for a side job, eh? What Mr. Zell did is he took advantage of a law passed by Congress in 1960, which created the REIT. He launched his company, Equity Office Properties Trust, which was an REIT which allowed the common citizen to invest with him in large commercial properties. And that's how he raised his capital. His company became the first REIT to become part of the S&P 500 on the New York Stock Exchange, so that anyone could buy its stock and be invested in these high-income, large commercial properties. By 2006, this company grew so large that Mr. Zell was able to sell the company for $36 billion to the Blackstone Group. So you can see some REITs may experience huge growth over time with good management. And the best part of an REIT is that they're required to pay 90% of their earnings to their shareholders. So as an investor, you get a majority of the profits. Here is one REIT that I personally invested in, which went up 21% over the past year and pays 2.7% in dividends on an annual basis. Dividends means you get paid out a certain percentage of whatever you invested into the stock, whether the stock price itself actually goes up or down. It doesn't matter. And if you reinvest those dividends to buy more shares of the REIT, those shares that you buy can also generate dividends themselves. Over time, if you continue to reinvest your dividends, this accelerates your investment growth through compound interest. And REITs typically have very high dividend yields because they pay out 90% of their profits to their shareholders, as mentioned earlier. Now, the next way you can invest in real estate is to invest into a syndication and become what we call a limited partner. A syndication is like giving your money to a real estate expert and having them manage it for you to buy an asset, and in return, you get a cut of all of the profits. Now, the real estate expert and syndicator is also called the general partner, or GP, and you and other investors are also called limited partners, as mentioned earlier, or LPs. Usually, when a GP buys a property, there will be a 25% down payment put on the property financed by the LPs, and the rest of the 75% comes from a bank loan, as you can see in this diagram here. Sometimes the GP may finance 5 to 10% of that 25% down payment, so that they have skin in the game. You can see that in the diagram here. What's really great about syndications is that as an LP, you can make money in several different ways. As the bank loan / mortgage is paid off every single month, a little bit of that money goes towards paying off the principal balance on the loan. This gives you equity in the property, which you split with the GP. The equity you gain over time is shown in the green area on this diagram. As the green area expands, the LPs and GP own more and more of the property, and the bank owns less and less of it. LPs and GPs also get equity in appreciation in the property over time, which you can see in this diagram, also in green. Usually the equity that you get from the loan paydown and the appreciation on the property are split between the LPs and GPs as 70% and 30% ownership, respectively. Finally, LPs get what you call a preferred return, which basically means that the LPs are paid first when profits are made. Usually a preferred return is anywhere from 8 to 12% or more. So when the company makes any profit that is 8 to 12% or less of the investor capital, that profit will be given straight to the investors first before the GPs make anything. Then, any further profit made after that 8 to 12% return is split between the LPs and GPs. As we mentioned earlier, the biggest pro to investing in syndications is that you don't have to manage it, which makes this opportunity really passive for you. As a limited partner, you don't have to do any of the work. You just put in your money and get a return. Now, the second pro is that you are not liable if the syndication is sued, because you don't have any say in managing the property. Basically, if the deal goes bust, you can't be blamed from a legal standpoint. Now, the third pro to syndicating is usually the GP can shield their investors from having to pay a majority of their taxes through something called a depreciation shield or deferred capital gains. Now, the pros are great, but there's also some cons. The first con is that you typically don't have voting rights as a limited partner. And so if the investment doesn't go well, the syndicators may vote and do what is called a capital call, which would require you to put in more money into the property or risk losing your ownership percentage in the deal. In fact, I actually had a friend who put his money into a syndication, and as you might be able to guess, they eventually had a capital call. Thankfully, my friend had additional funds that he could put into the syndication. But one of the other investors didn't. And because that investor didn't put in additional money, he basically had to forfeit his complete initial investment of $8,000. That is a lot of money, but there was nothing he could do because he got diluted out. What a nightmare. And this brings me to the second con of investing in a syndication deal, which is that you could actually lose all of the money you invest if you choose the wrong operator. And that's why I recommend you choose a smart operator who has several years of investing in their respective real estate field. If, for instance, the tenants decide to stop paying the syndicator operator, the deal could continue to lose money until they are forced to sell the asset for a cheaper price than they got it for. So, you need to realize that whatever return that the operator projects you will make, it's not guaranteed. Finally, we have the third con of investing in a syndication, which is that the minimum investment is high. Usually it's $50,000 or more. So make sure you have enough capital available before you get into these syndication deals. Finally, make sure the syndication has a track record of 5 years or more. Ensure that you talk to at least 3 of their past clients or references, and discuss all contracts that they send you with a real estate attorney. Finally, be very careful who you invest with, even if it's Grant Cardone. Sorry, Grant. No hard feelings. Choosing a bad operator can really stress you out because you'll be worried every day about losing your hard-earned money. Now, the third passive way to invest in real estate is to buy a turnkey property. What is a turnkey property? It's a property that doesn't require much work at all in order to rent it out for a good positive cash flow. In fact, a lot of turnkey properties might already have renters in them that cover the mortgage and make cash flow on top of that. When I actually sold my very first property to an investor, she ended up having cash flow on day one because I had renters in there and their lease lasted another couple months. Turnkey rentals are exciting because you own 100% of that asset, and in some cases you might have cash flow on day one, like in my case. Let me tell you, if your property already has renters, there is no better feeling than getting paid on the first of the month every single month with consistency. It's basically, to use that famous phrase, making money in your sleep. The only problem is when the current tenants leave, you'll need to make sure you market your property ahead of time so that you find new tenants. I really enjoy buying turnkey properties sometimes because I can use that cash flow on day one to reinvest into that property to make additional renovations, add bedrooms, and what I do is I rent out the bedroom to generate more cash flow. This way, I don't have to pay for those improvements out of my pocket. Instead, I can use the cash flow that I have on day one. Finally, let's go over the fourth passive investment, which may be a way to make a higher return compared to the REIT or the general stock market. A higher return allows you to build up more capital faster so that you can buy more properties quicker. And this passive investment vehicle is called crowdfunding. Unlike syndications, crowdfunding allows you to invest lower amounts of money like the REIT. One example of a crowdfunding company is Fundrise. And this is not a paid sponsorship or anything, this is just one of the platforms out there. As you can see on their website, Fundrise shows an average 65.4% return for those who invested for 8 years, which is about a little more than 8% per year. And the annual returns have been positive every year except for 2003. At some crowdfunding companies, you may also have a chance to vet out the specific projects that you invest in. Overall, crowdfunding is a great way to diversify your real estate investments while being as hands-off as the REIT. And that's it. Those are the 4 most passive ways to invest in real estate, if you don't have that much time available. If you learned something new and found this video helpful, please give it a thumbs up, subscribe, and share it with your friends so that it can reach more people who are struggling with getting started in real estate investing. Thank you so much for watching, and I'll see you on the next video.